Hey everyone, Graham Stephan here. I'm thrilled to talk to you today about something that has the potential to change your life forever. Yes, you heard that right. We're diving into the world of real estate, a realm where dreams can become reality and financial freedom is within reach. Ever dreamt of financial freedom? Imagine waking up every day knowing that your investments are working for you, generating income while you sleep. It's not just a fantasy, it's a goal that many have achieved through smart real estate investments. Real estate might be your answer. Whether you're looking to buy your first home, invest in rental properties, or flip houses for profit, the opportunities are endless. The key is to understand the market and make informed decisions. It's a powerful way to build wealth. Real estate has created more millionaires than any other industry. The combination of property appreciation, rental income, and tax benefits makes it an attractive option for building long-term wealth. But where do you start? The real estate market can be overwhelming, especially for beginners. With so many options and strategies, it's easy to feel lost, but don't let that discourage you. Every expert was once a beginner. Don't worry, I'm here to guide you. With years of experience and a passion for teaching, I'm committed to helping you navigate the complexities of real estate investing. From understanding market trends to finding the right properties, I've got you covered. Let's dive into a simple yet effective strategy, the 1% rule. This rule is a great starting point for evaluating rental properties. It states that a property should rent for at least 1% of its purchase price each month. This helps ensure that the property will generate enough income to cover expenses and provide a profit. This rule can help you make smarter decisions. By focusing on properties that meet the 1% rule, you can quickly narrow down your options and identify the best investment opportunities. It's a simple yet powerful tool that can save you time and money. It's all about finding properties with good cash flow. Positive cash flow means that your rental income exceeds your expenses, providing you with a steady stream of income. This is crucial for building a sustainable and profitable real estate portfolio. Ready to unlock your real estate potential? Let's go. The journey to financial freedom starts with a single step. With the right knowledge and guidance, you can achieve your real estate goals and create a future filled with possibilities. So, are you ready to take the plunge? Let's dive in and explore the exciting world of real estate together. The 1% rule is super straightforward. It states that a rental property's monthly rent should be at least 1% of its total cost. This includes the purchase price, any renovations, and closing costs. Think of it as a quick check for potential profitability. If a property passes this rule, it might be a good investment. But remember, it's just the first step. We'll explore more factors later. Imagine you find a property you love. It's in a great location and needs minimal repairs. But how do you know if it's a good deal? The 1% rule comes in handy. By quickly comparing the rent to the property cost, you can quickly assess its potential. Remember, this rule helps you filter out potentially unprofitable properties early on. It saves you time and effort in the long run. Let's say you find a condo listed for £200,000. This condo is in a desirable neighborhood, close to public transportation, schools, and shopping centers. The location alone makes it an attractive option for potential renters. However, the property needs some work before it can be rented out. The kitchen is outdated, the bathroom needs new fixtures, and the walls could use a fresh coat of paint. These renovations are essential to make the condo appealing to tenants and to justify a higher rental price. You estimate £10,000 for renovations and closing costs. This includes the cost of new kitchen appliances, bathroom fixtures, paint, and labor. It's important to get multiple quotes from contractors to ensure you're getting a fair price. Additionally, you should budget for any unexpected expenses that might arise during the renovation process. Closing costs can also add up, including fees for inspections, appraisals, and legal services. All these expenses need to be factored into your total investment cost. That brings your total cost to £210,000. This figure is crucial because it will help you determine whether the investment is financially viable. You need to ensure that the rental income will cover your mortgage payments, property taxes, insurance, and maintenance costs, while still providing a reasonable return on investment. It's also wise to have a contingency fund for any unexpected repairs or vacancies. Using the 1% rule, your target monthly rent should be at least £2,100, which is 1% of £210,000. The 1% rule is a quick way to gauge whether a rental property will generate enough income to cover its costs. If the monthly rent is at least 1% of the total investment, the property is likely to be a good investment. However, this is just a rule of thumb, and should not be the sole factor in your decision-making process. If you can rent it for £2,100 or more, it might be a good investment. But before you make a final decision, consider the local rental market. Research comparable properties in the area to see what they are renting for. Talk to local real estate agents and property managers to get a sense of demand and vacancy rates. High demand and low vacancy rates are good indicators that you will be able to rent your property quickly and at a desirable price. But remember, we need to consider other factors too. These include the property's appreciation potential, the overall economic climate, and your long-term investment goals. Real estate investing is not just about immediate cash flow, it's also about building equity and wealth over time. Make sure to conduct a thorough analysis and consult with financial advisors to ensure that the investment aligns with your financial objectives. By taking a comprehensive approach, you can make informed decisions and maximize your chances of success in the real estate market. The 1% rule is a fantastic starting point for new investors. It's easy to understand and apply. It helps you quickly identify potentially profitable properties, and it gives you a baseline for your rental income expectations. However, like any rule of thumb, it has its limitations. Let's explore those next. The downside limitations to keep in mind. The 1% rule doesn't account for all expenses. You'll have property taxes, insurance, potential vacancies, and maintenance costs. It also doesn't consider your local market conditions. Some areas might have higher or lower rental yields. Therefore, while the 1% rule is a useful tool, it's crucial to consider other factors before making a decision. Beyond the 1% rule, additional factors to consider. When evaluating a property, look beyond the 1% rule. Research the neighborhood, its growth potential, and average rental rates. Factor in all expenses, including potential vacancies and repairs. Calculate your cash flow to ensure it meets your investment goals. Remember, due diligence is key. Don't rush into a decision based solely on the 1% rule. Real-life scenarios. Applying the 1% rule wisely. Imagine two properties. A modern flat in a bustling city center. This flat is located in a prime area, surrounded by amenities like cafes, restaurants, and shopping centers. The demand for such properties is usually high, which means you can command a higher rent. However, with higher rent comes higher expectations from tenants. They might expect top-notch facilities and quick maintenance services. Additionally, properties in city centers often come with higher property taxes and insurance costs. Now consider a cozy cottage in a quiet suburb. This property might not fetch as high a rent as the city flat, but it has its own set of advantages. Suburban areas often have lower property taxes and insurance costs. The tenants in these areas might be families looking for a long-term rental, which can mean more stability and less turnover. The maintenance costs might also be lower, as suburban properties often have fewer wear and tear issues compared to city flats. The flat might rent for more, but expenses could be higher. For instance, if the rent for the city flat is $2,000 per month, but the monthly expenses, including maintenance, property taxes, and insurance, amount to $1,500, your net income is only $500. This is where the 1% rule comes into play. According to this rule, the monthly rent should be at least 1% of the purchase price of the property. So if the flat costs $200,000, the rent should be at least $2,000 to make it a viable investment. The cottage might have lower rent but potentially lower expenses too. If the rent for the cottage is $1,200 per month and the monthly expenses are $600, your net income is $600. If the purchase price of the cottage is $120,000, the rent meets the 1% rule. This means the cottage could be a better investment despite the lower rent because the expenses are significantly lower. The 1% rule helps you compare these properties objectively. It provides a quick way to gauge whether a property is worth considering. By comparing the rent to the purchase price, you can quickly eliminate properties that don't meet the criteria. However, it's essential to remember that the 1% rule is just a guideline. It doesn't account for all the nuances of real estate investing, such as market trends, property appreciation, and personal investment goals. But the final decision depends on your risk tolerance, investment goals, and market understanding. Some investors might prefer the stability of suburban properties, while others might be drawn to the potential high returns of city flats. It's crucial to do thorough research, consider all factors, and perhaps consult with a real estate professional before making a decision. The 1% rule is a valuable tool, but it's just one piece of the puzzle in the complex world of real estate investing. Your real estate journey begins now. Take action. The 1% rule is a powerful tool for new investors. It simplifies property evaluation and helps you make informed decisions. Remember to consider all factors, do your research, and don't be afraid to seek expert advice. Now go out there and start building your real estate empire. I believe in you.